Quality stocks get 1% a year. Minimum volatility stocks give you 2% a year. And multi-factor. And we have this multi-factor model where you're putting about 17% of your portfolio in each of these different factors. And you get 274 basis points better than the S&P 500 with lower downside. Now, much of my time. Here is a little infographic here. This is return 5% to 9%. This is the market at 5.4%. This is the average investor under the market. And then across the bottom here is a risk measurement of standard deviation. It's a way to best be able to measure risk. And all of this trading that individual investors do is actually adding to their risk and not giving them an increase in returns. And the market is where the market is. So let me just show you a couple of graphs here. This is how the S&P 500 did, $100,000 to $257,000, 5.4% return. And then if we chose just value stocks, and some of the examples today of value stocks, Exxon is a value stock, JP Morgan is a value stock, Pfizer, AT&T, all of these stocks are dividend paying. Value outperforms the S&P by that 1% a year and gives you a much better return over time. What about, so value has moved you up in return and over lesser risk than the market. Small cap stocks. Similar situation, S&P 500, small caps gives us better returns, 7.6%, but we have increased our risk. And look at this right here. We had these two back-to-back corrections in the beginning of end of 16. This was the August the 15th flash crash. And then we had this January 2016 dip in the market. Look at what small caps did. Down 30% during that period. Small caps down 60, almost 70% high to low during the great financial crisis. So small cap stocks go down more than large cap stocks. So we're actually increasing our risk with small cap stocks. And just a fact. Quality stocks. Apple, Visa, Home Depot are quality stocks. They have low debt, high profit margins. Quality has outperformed. And quality gives you less risk. And then lastly, momentum. Momentum, Google, the FANG stocks are all momentum stocks. And there's a way, there's investment vehicles, there's mutual funds, there's ETFs that set up a model so you're always rotating into the stock with the higher momentum. So this is a strategy that you can implement and it's done for you automatically with an ETF. But momentum stocks have proven to be an outstanding additive to your portfolio. And then momentum is a little higher risk than the S&P. So now, what do you do? What happens when you merge all these things together and you take into account the business cycle? Because business cycles change the characteristics of stocks over time. Multi-factor investing reduces risk and increases returns. And we move from a 5.4 to an 8.1 over a 20-year period of time by adopting a factor approach. So now what you're doing is increasing return and lowering risk. So that's how that works. So let me just summarize factor investing, because then I'm going to talk about some ETFs. And one of the things my dad got our clients and got us started in no-low mutual funds. In 2005, I changed our family newsletter from mutual funds to ETFs. And I'm a big proponent of ETFs, and I'm sure many of you know and use exchange-traded funds. And I'm going to talk about factor exchange-traded funds from BlackRock in just a second. Let me summarize factor investing. Factor investing is based in science and is supported by 9 decades of academic research. These numbers are bulletproof. They're peer-reviewed. My compliance department is extremely strict, and we're giving you good data here that we have a high degree of confidence in. Factor investing can be implemented in mutual funds, ETFs, or separately managed accounts. That's what SMA stands for, at a very low cost. The ETFs I'm going to talk about today cost 15 basis points. Glad I'm out of that business. Factor investing consistently works across domestic, international, and emerging markets. I didn't have enough time today, but there's evidence that shows for a 50-year period that factor investing works in international and emerging markets. So let's talk about exchange-traded funds. I realize you cannot read the data here. There's 2 things I want you to read. This ticker symbol, VLUE. This is called a tear sheet or a data sheet on an exchange-traded fund. Any ETF that you can buy publicly has one of these sheets. It's a 2-page document that gives you the strategy, the top holdings, the costs, and you just put in the ticker symbol into Google, VLUE. This is the iShares value. This is the USA value ETF. There's a international ETF. There's an emerging market value ETF. But right now I'm just talking about the value ETF. And this can be a position that you can own in your portfolio and sleep well at night. It's that simple. Now I'm going to talk about this in my concluding comments. But I'm not recommending that you just rush out and buy $10,000 of value ETF. One of the things that you have to do as an investor and as an individual investor, a self-directed investor, as many people are in this room, is you have to do a little bit of analysis on what you have now in your portfolio. I'm not going to ask for a show of hands, but many of you may have positions in the FANG stocks. Facebook, Apple, Netflix, Google, Amazon. Those are momentum stocks. They're momentum stocks. So you wouldn't want to add more momentum to your portfolio when you have all those momentum stocks already. Follow me? Maybe you have a position in a small cap mutual fund, or a position in IWM, which is the small cap ETF. I don't know. What you should do with this information is dependent upon where you sit, meaning what you have today in your portfolio. But I'm giving you this information, I'm sharing these 4 ETFs with you because they are an easy way and an inexpensive way. There it is. You can't read it, I realize it. But you can own this ETF for 15 basis points. I sarcastically mentioned I'm glad I'm not in that business, because if you had $100,000 in the BlackRock ETF, they're going to make $150. That is no way to make a living. So, there's just no money. I mean, Vanguard's doing stuff right now at 5 basis points. Cool. That's just my opinion. Now, those are good products for your investment portfolio. These are great things for investments. But as you know, it's just difficult to make a living there. So, let's talk about the size ETF. SIZE. This is the BlackRock iShares Small Cap ETF. And it's a very simple way to be able to add small caps to your portfolio. If by chance there was a stock in this small cap portfolio that grew, so it's no longer a small cap, BlackRock is going to fix that. They're going to make that portfolio change. If there's a value stock in the value stock ETF, and sometimes it's no longer a value stock, they're going to make some changes from time to time to this portfolio. There's not high turnover, but their job is to keep all the stocks in the ETF in that space. The momentum ETF. And again, I know that Netflix is in this ETF. I know Apple is in this ETF. And again, this is is an exchange-traded fund that is going to be much more volatile than the value ETF. But so far this year, momentum stocks have been doing better than value stocks, and this is why we own them on a combination basis for our clients. And then lastly, quality. QUAL is the quality ETF, and Johnson & Johnson, Charles Schwab, BlackRock is even on that list of quality ETFs, quality stocks within the portfolio. Again, all of these ETFs are at 15 basis points. So, let me bring this presentation to a close and open things up for questions, because I want to be mindful of our time, and I'd like to hear from you the questions that you have for me. The way you start implementing a factor investing strategy in your own portfolio is you need to go back to what you currently own. And I always ask investors a very important question, and I'm asking this question to have you think about it. What rate of return are you actually seeking on your portfolio? And when you look at this rate of return, through the lens of your equity exposure, let me make this simple. Let's just use this concept. Over the next 10 years, the stock market is going to do 10% per year, and we want to participate in that. But in order to be able to get the 10% per year, you got to be 100% invested in stocks. You just may not be comfortable being 100% invested in stocks. That may be because that you have some income needs, and you're at a point in time where you're drawing out your required minimum distribution. We like to discuss with clients, because we're a firm that believes in financial planning, that the monies that you need in your portfolio in the next 5 years for cash flow purposes, for your distributions, should really not be invested in stocks. They should be invested in fixed income. But the money that you don't need in the next 5 years, you can invest that money in equities. So that might mean that you need to have an 80-20, 80% equities, 20% portfolio, 70% equities, 30% fixed income portfolio. There's going to be some sort of asset allocation. But to go from being 100% invested, and then you go through a month like we had during the last month, where stocks correct almost 10% in 2 weeks, it's just too bumpy of a ride. That's another reason to be more diversified. But you're not going to achieve the full potential of the stock market, and maybe you don't need to. I'm not saying you need, that doesn't need to be your end game. I'm going to tell you that residential real estate here in California is going to continue to do 6% a year for the next 10 years. Is it going to do 6% next year? Maybe, maybe not. Okay, it doesn't matter. You're living in your home. Who cares? Okay? How did you make money in California real estate? You sat still. That's how you make money. So we need to apply that same wisdom to our investing portfolios. And figuring out how to start to implement a strategy where you can get a smoother ride and better returns requires that you understand what you have now in your portfolio. So, right now, again, in this kind of market, the fact that we've been in a momentum stock market the last couple of years, I would bet the one ETF you don't need in your portfolio is probably momentum. Because you've got Apple, Google, Netflix, or you've got some higher growth stuff, but you probably don't have the value stuff. Or you probably don't have the international. That's where you're going to get better diversification. I want to come back to the issue of diversification. If you own just one ETF, the Vanguard Total Stock Market ETF, ETI, you're instantly in 3,000 stocks. You're not going to have to worry about a GE going out of business or a Bitcoin or any of that weird stuff that's going on there in the markets. You don't even have to worry about the fact that every single one of the FANG stocks right now is in a bear market. Every single one of the FANG stocks is now down 20% or more from its 52-week high, which is a bear market. So you don't have to worry about that stuff. When I take a look right now at the exchange-traded funds I just shared with you, I would encourage you to look at value and quality as two areas to consider for your portfolio. Look at those, you can get those tear sheets, look at those stocks, have a better understanding. Now, I'm going to mention something, and my colleague Jeff is going to hand out a postcard to you folks. If you would like to get a copy of this presentation, if you would like to get my podcast, I just did this year 3 podcasts on factor investing. And a podcast obviously is a radio recording. You can listen to it on your smartphone. You can listen to it. You can listen to it online. Just go to the webpage and click on it, and there I am. I have a rule that I keep my podcast to 20 minutes, like a TED Talk. I'm a big podcast guy, and there's some podcast people who have 3-hour shows. I don't know how. I don't have 4 hours to play golf, and I don't have 3 hours to listen to a podcast. So I try to be conscious of people's time and do things in about 20 minutes of time. So I think if you would like, copy this presentation, 3 additional podcasts on factor investing. I'd be more than glad to deliver that to you via email, and I'll get your email address with our postcards. So Jeff, if you wouldn't mind handing out those postcards, and I will now go to Q&A, ladies and gentlemen. We have 10 minutes for Q&A. Sir, can I answer your question?
You said that nothing that happens in Washington will affect the stock market. What about the trade war?
I'm sorry, a trade war. That's just volatility. It is not in, I'm editorializing now, this is my opinion. It's not in everybody's best interest to have a trade war, okay? Now, President Trump has taken the stance that he is a tough negotiator, and so he has raised the bar higher than anyone has ever raised the bar against China. And they're going to work it out. Now, if we go into a full trade war, could the stock market go down 30%? Yes, it could. But that is an unlikely outcome. Even though the talking heads would like you to believe it's a high probability outcome, it's a low probability outcome. It just is. Yes, sir. Questions? Yes, ma'am.
Recently, Morningstar interviewed John Bogle, and one of the things with the honorable.
I know who he is.
Yeah. One of the things he mentioned is that it's better not to invest internationally at all because the money of U.S. already internationally are invested.
I understand that point of view. The lady is bringing up a question, or excuse me, a comment from John Bogle that he made the comment that, hey, you can do fine just investing in U.S. stocks. You don't necessarily have to go overseas. And I understand that point. I'm of the belief that 95% of the world's population is outside of the United States. And the United States stock market is actually at a higher valuation than overseas stocks. And historically, if you look at the data, you will increase your returns and lower your risk by owning international and domestic. But I understand that some people are just not comfortable. You know that 1/3 of Americans don't have passports? 1/3 of Americans do not have a passport. They are never leaving. They don't plan to leave, they don't want to leave, they ain't going anywhere. I get it, not a problem. But the scientific research shows that you will increase returns and lower risk by having some international exposure. Okay? Questions, ladies and gentlemen? Questions of, yes, sir?
Yeah, is there an ETF that would combine various modalities you talked about, like value and
Yes, sir.
quality?
Great question. Gentleman's asked me, is there an exchange-traded fund that offers the multi-factor approach as opposed to blending them together? And yes, there is. You can just Google multi-factor exchange-traded fund. iShares has one, and a couple other firms do too. Yes, great question. Thank you. Thank you. Yes, sir.
So when comparing ETFs, you indicated one thing to look at is the management fee.
Yes.
What are some other important things to look at when you're comparing ETFs?
Well, the gentleman is asking about selecting an exchange-traded fund and what are some other characteristics that you should look at. I believe that the expense ratio is an indication of, there are some expensive exchange traded funds. I'll just bring up the leveraged ETFs. ETFs that are using margin to buy additional shares, so you can get 2 times the S&P 500, or you can go inverse of the S&P 500. These exchange traded funds are expensive to own. So the expense ratio is important. The second characteristic that I would look at is the management team. I mean, how long, there are about 50 different companies that offer exchange traded funds. But some of them, like the Spiders, iShares, and Vanguard, have been there since the beginning. So there's a lot of esoteric products in the exchange traded fund world. There's an ETF that you can just own solar stocks. You can own solar stocks by owning broader indexes. You're really making a bet on a particular industry segment, and I would stay away from that kind of stuff. So my coaching is expense ratio, and volume also matters. How many other people are in that ETF? Because that has to do with the efficiency of the pricing. Good questions.
Thank you.
Yes, sir, to back.
You never mentioned anything about income investing or dividends. Why?
Thank you. Thank you. Well, that's part of one's personal investing profile. During our one-on-one conversation, I would have that kind of discussion, from a planning perspective with a client. We didn't talk about taxes either. Fixed income, should you be in munis, should you be in corporates? Those are some nuances. But that is really about customizing and tailoring the strategy to a family. But obviously there are dividend-paying ETFs. Dividends give you a tax advantage. But the value ETF is a dividend. Every stock in the value ETF is a dividend payer. So that can be a strategy that is a part of the overall mix. But it's not part of the the factor investing strategy. I'm not saying there's anything wrong with seeking dividends or thinking in terms of income. But there's just nuances. And again, I'm giving you today a broad way to look at equity exposure and customization to your family's needs and goals is kind of a sidebar situation. I did want to mention something, folks, just on that card that I gave you. I just need your email address. Now, it does say phone number. One of the things that I do on my radio show is I do wealth coaching. And that's where I have a one-on-one free consultation with investors. I do that for content, and I do that to help people. And if you wanted to have a conversation with me, I'd be more than glad to have a 15-minute, 20-minute, half-hour conversation with you about your situation, answer some more personal things. I will also be here at the break. I'm staying for the next speaker, and I'm going to be here for the rest of the afternoon. So if you want to get a few minutes with me to be able to answer questions, that would be great. Let me take one more question. Sir.
What's the relationship between multi-factor investing and you're talking about smart beta?
Gentleman's asking me to clarify the differences between smart beta and multi-factor. Smart beta is kind of a new term. It's really a marketing term in the world of exchange traded funds. There are some ETFs that use a smart beta where they have back-tested a strategy that where you were to overweight, and an example is minimum volatility. Minimum volatility ETFs are actually a smart beta ETF where you're adjusting the portfolio in such a way, you've done some historical research, and you're trying to improve the results. And so the difference between smart beta and multi-factor is really the peer-reviewed research. The peer-reviewed research of factor investing has won economic Nobel Prizes. And somebody in their garage with a computer working for an ETF company, I got it, this is going to work, is just not peer-reviewed, and many times they haven't back-tested it that far. So that's not common. Ladies and gentlemen, you have been an outstanding audience. I've enjoyed it. I'm looking forward to
We'll take 10 or 15 minutes and be back for our second